Well, hello, everyone. Good afternoon. Good afternoon. I'm going to interview Bob here. But I do have to warn you, he does have at least a little bit of warning of some of the questions I'm going to ask him. But let me first introduce Bob Stack. He's the Deputy Assistant Secretary for International Tax Affairs at the Treasury Department. And he's responsible for the conduct of legal and economic aspects of tax policy relative to all matters involving cross-border taxation. And among his many duties, he serves as the U.S. delegate to the Organization for Economic Cooperation and Development, as we all know, the OECD, which is in Paris. Prior to joining Treasury, Bob served as the head of the International Tax Practice Group at the law firm of Ivins, Phillips & Barker, and he has over 26 years of experience on international tax matters. Bob, thank you for speaking with us today. Let's go back a year now, because we did this, I guess, exactly a year ago now, and we had a conversation. And last year, our entire conversation was about BEPS. It was about the OECD project concerning base erosion and profit shifting. And as everybody knows, in 2012, the G20 initiated a project to study the inappropriate reduction of countries' tax base by shifting profits to avoid tax. And then last year, right about the time that we spoke, the 15 action items, the reports on the 15 action items came out on many different subjects, and there was a lot of great interest about that, and there was a lot of concern, particularly in the U.S. business community, what effects the BEPS project would have on United States companies and on international investment. Well, now we're a year later, and you know, in some ways, as we were just saying out in the hall, you know, my impression is it's somewhat dropped out of the front page of the tax press, and you know, just moved down a little bit. You know, the state aid stuff has obviously moved up, and of course our elections have you know, taken some of the interest out of BEPS. But where do we stand now with regard to the BEPS project?
So I think what happened, what you saw last fall, was there was a big kind of everybody just had a sigh of relief when we were done, because it was such an enormous effort, and there were 15 items and so much detail across them. But what we did move very quickly to were, I think, 3 highlights of it. One was just kind of moving into the implementation. And then we've got some ongoing work, and then we actually enlarged the frameworks. I'll just talk real quickly about each, because I know we only have half an hour. So there were 4 minimum standards that were put forth in BEPS that countries had to agree to. First was to do country-by-country reporting to tax authorities. Second was to avoid having harmful tax practices like a patent box. And within that same to-do list, to have countries exchange rulings about cross-border transactions that affect the parties to the ruling, so countries could see that, have some transparencies into things like the Luxembourg rulings. Third was to agree to put treaty abuse provisions in your treaties, like our LOB. And the fourth was to bring countries together to improve the dispute resolution among countries. So one of the things that'll happen now is we'll step back in BEPS and we'll say, well, our country's actually doing what they committed to do in the minimum standard. The second thing we've got is just some of the ongoing work. I spent a couple of weeks ago, the Digital Economy Task Force met this year to see where we're going to take the digital work. There's a lot of monitoring to do to see if the BEPS stuff actually had some effects. You can watch how the new technologies are advancing and making those issues, you know, harder or easier, and then think at some point, if appropriate, about are there more policy answers to be done there. In transfer pricing, we're looking at attribution of profits when there's a PE, because there's been a change in the PE rule, and also things like profit splits. And finally, the other big thing that happened was the G20 wanted to kind of include developing countries in the base erosion and profit shifting work, and so we expanded the people that come over to this ongoing BEPS work to something we now call the inclusive framework. And there's something, I don't know the precise number, but 80 and 100 countries now around the table kind of working on these BEPS implementation issues. So there's a lot going on. I agree with you, it's not all as high headline as it was the last time, but the work continues, but not at the same crazy pace that it was, you know, a couple of years ago.
Yeah, there was talk a year ago about the next phase being monitoring. and also a focus on tax administration, because now it's moved in some ways to actual implementation. Could you comment with regard to, what's meant by monitoring and whether you've seen particular actions taken with respect to that? And also, tax administration, has there been an outreach to, tax administrations around the world? You mentioned to the developing countries. Has there been more of that? So
the monitoring is really just looking around the world and seeing, are people enacting the C/by-C rules? Are they coming into the map, improving administration? Are they kind of doing what they said they would do? And then in the digital space, it's a little bit about what new laws are being put into effect where, and how we might analyze them. The tax administration issue morphed actually into work. I think that's important that the U.S. pushed, not so much focused on administration narrowly, but more broadly on using the OECD to help countries understand that investment in their countries depends to a great degree on certainty in the tax environment. So that might be the absence of retroactive rules. That might be auditors and administrators who apply the rule of law. It might be having consistency in your tax laws and not jumping around from year to year. So we're getting into the space of, and this was supported by the Chinese and the G20 and now Germany coming forward, and this will start a stream of work that should go on for a while that ultimately we hope will end with some kind of practical real-world tools for countries to use to promote tax certainty. So I feel good about getting that on the agenda, and that work will go on for a while.
Yeah, just as an observation, various folks have expressed concerns that after the 15 reports went out, countries will have lots of ideas in order to expand their tax base or be more aggressive with respect to administration. And therefore, one of the goals of the OECD is actually to facilitate cross-border investment, and what we could end up with is countries around the world taking unilateral actions. Does the OECD, is it taking steps to try to address those? Is it through this education, through this monitoring?
Well, actually, I think one of the issues confronting the OECD, I think, is that we have come to some consensus on some things in the OECD, and then have watched other people take the consensus and go to the next level. So the clear example of that is the country-by-country reporting agreed at the OECD was something that was to be exchanged among tax authorities and kept confidential, only to see the Europeans then, they're still working on this, it has not happened, but propose that perhaps this should be publicly posted by companies on their websites. And so the tension that puts in the system is, well, why would countries come together and agree in a multilateral environment on what you might view as a baseline if the minute you leave the room, countries are going to take that as the baseline and double down and go to the next place? I think it's a real challenge, and I think the Europeans are demonstrating more and more a penchant for unilateral action than necessarily staying with the agreements that they make in the multilateral setting. I think that's a challenge for my successor.
Well, I would also say that that's inevitable. I mean, whether or not we have the BEPS project and the reports, I mean, each country is going to take its own national interest into account, whether or not we've had the BEPS project.
And as we were saying outside, I mean, the issue then becomes for policy folks is, do you want to be in the room or out of the room? Do you want to have everybody at the table or not at the table? So it's actually quite delicate to manage. Digital is a really good example of this. If you don't bring countries together to say, well, what are the problems and how might we fix them? We already know countries will unilaterally enact their own provisions because they have the perception of an issue. So it's not easy. Our prejudice is it's better to be in the room than not in the room.
Well, an example of that is a multilateral instrument.
Yeah.
I know that the United States was reluctant to participate in the discussion about the multilateral instrument. My understanding is now the United States is involved in that project.
Yes.
Could you talk about what's going on with the multilateral instrument?
Yes, so the multilateral instrument has moved along very quickly. There's a bunch of BEPS-type provisions. There might be one on partnerships and transparent entities. There's a principal purpose test that I think you all know about. There's one on dual resident companies. So it's kind of the BEPS deliverables, not minimum standards, except for the one on treaty abuse. And they needed to devise an instrument, as lawyers I think we can appreciate, they needed to devise an instrument that could simultaneously amend up to 3,000 bilateral instruments around the world on these various provisions. They've done that. It's set to be I think, initialed in November, and then open for signing next year and on time. And it's been really a remarkable accomplishment.
But for us, of course, it would require changes to the treaty that have to go through the Senate. So
Yes.
it seemed to me that in large measure, the United States is in the room, but in many ways an observer, because it has to go through our normal treaty process.
It's not just that. It's just that many of the provisions that are in the treaty we already have in our treaty. So we have a robust LOB. We didn't really need the new thing being done.
The anti-avoidance?
Yeah, anti-avoidance.
The anti-avoidance aspect of it.
We already have a look-through provision on hybrid entities in our treaties. And so the one thing we might have gotten out of it was the arbitration, which is okay, but we're just going to have to evaluate whether at the end of the day there's something there.
Oh, yeah, and tell me a little bit more about the arbitration. Is there anything you can say about the arbitration?
Well,
because we like baseball arbitration.
Yeah.
I know there's been a reluctance by many countries to accept baseball arbitration. Is there anything you can say?
No, about several months ago, I think there were 20 countries, we called it the Coalition of the Willing, who said, yeah, let's all get arbitration. So there is a move to move towards the baseball-style arbitration in the multilateral instrument. It's got a little more flexibility than in our treaty, and countries have been free to make reservations, which means they're not going to use it in all circumstances, so it's not perfect. But it's a real advance for arbitration around the world, and some countries will take it and some won't.
So that really is something that will help the United States coming out of this.
Assuming we sign, we ultimately join that provision as opposed to go and negotiate our own bilateral arbitration, which we already have in many of our treaty partners. So there's kind of a different calculus there of.
But just so I understand, with respect to the 20 countries, though, we don't have to sign on the whole thing to get the arbitration with the 20 countries.
No, we would have to sign the arbitration provision.
Very good. Let's segue to transparency and country-by-country reporting. The regulations are now final. They're effective, in essence, after July 1st, 2016. So for calendar year taxpayers, they'll be in effect for 2017. Other countries have put these rules in effect for country-by-country reporting starting in 2016. One of the issues with respect to finalizing the regulations was, well, what to do about U.S. companies with subsidiaries in situations where other countries would want information about the subsidiaries for 2016, where our system is not yet put in place. The preamble to the final regulations say that the United States is trying to work something out with the other countries where the U.S. companies would report to their parent, and then the parents would exchange it with other countries, hopefully other countries going along with that approach for 2016 for U.S. companies. Can you comment on that? Can you give us more details about those discussions and the discussions with the other countries?
Yeah, so just for everybody's benefit, if you were a calendar year taxpayer and your year started January 1, 2016, you were not required to do country by country to the U.S. Because our regs didn't get effective till July 1. But working with the OECD and the other countries, we really came to a very broad agreement, universal really, to say countries would accept what we call a voluntary filing by those companies starting January 1 through the IRS to be given over to the other countries. And the IRS did a lot of work to be able to kind of step back and make sure that it could accept and have a mechanism for accepting those voluntary contributions. 2 points on that. I think we're expected to do a rev proc at some point in a timely manner so that the mechanism for doing the voluntary filing is known and widely available. And second, IRS will be concluding bilateral exchange agreements. These are really form documents. It's not like negotiating an intergovernmental agreement in FATCA, so that everybody's set to exchange the information in a timely way in 18. The thing I want the audience to appreciate is I've been hearing here and there little ticks and things about this country hasn't done this reg yet to accept the voluntary. I just don't have a concern that that's going to be a real problem, because countries through the OECD process will fully on board with this result. So I would just say, sit tight, we're going to be fine.
Very good. Why don't we transition now to the state aid investigations? As everybody knows, the European Commission a couple years ago initiated investigations with respect to anti-competitive agreements between foreign governments and various companies around the world. Also, anti-competitive actions taken by governments as a whole. And of course, in the newspapers, we've seen reference to some of the findings by the European Commission. One of the best known, of course, is Apple in Ireland. In August, the Treasury Department put out a white paper criticizing these investigations. And you know, since the white paper went out, has there been any further discussions with the EC? What's the current status of the Treasury Department's role in these matters? And is there anything the Treasury Department can do?
Look, I think the whole purpose for us to step up and say, wait a second, were a couple of real serious U.S. interests here. When we began this, there were 3 or 4 U.S. companies under investigation, and the concern was that if we were not vocal in protecting our company and our tax interests as the United States, that there could be 13 or 14 or 15 before you looked up and realized, what was happening. That was number one. And number two, there's a chance that as these penalties are assessed in the state aid investigations, they were going to be creditable. And so there was a real stake of dollars, for U.S. taxpayers. I would note that we've taken a little bit of a hit in some U.S. quarters for looking like we're defending multinational tax avoidance, but I find that such a strange argument if the U.S. taxpayers are going to ultimately wind up footing the bill through a tax credit when either the money's repatriated or we do a deemed repatriation in connection with tax reform. But anyway, so we got out there, we were very vocal, even before some of the decisions came out. We've had lots of interaction back and forth. 2 things. I don't know if we know kind of the full effect of what obviously I did never expect that we were going to derail ongoing investigations. But the question is, have we made our concerns known about really retroactivity and walking away from multilateral tax fora in such a way that we can, that they may moderate their behavior in the future? We'll never know the answer to that. And then I think secondly, these things, it's not necessarily like a tit for tat, like this is the next thing we'll do to them. But we have a whole range of relations with the EU, and this is a bit of a thorn in the side right now, and it goes beyond just narrow tax issues. But I don't have an announcement of, there's this next thing we're going to do. The Hill has been engaged and involved, and so we all have to sit back and wait and watch it as it moves on.
Moving on to U.S. tax reform, just for a moment. Just talk about where the administration is right now. I know the administration in 2012 put out a framework and then has updated the framework. I know the administration is going to be changing. Are there any thoughts with respect to any comments where the administration on, for example, on lowering the tax rate or even going to a territorial tax system? Yeah,
so a couple of thoughts. I mean, and I think these are more personal just because we're not up there right now negotiating. But one of the thoughts I have uniquely from my international perch is that even if you do a territorial tax system, if U.S. multinationals don't get on board with an international tax system that can bring more stability to the international structure, by that I mean avoiding a plan that lets deferred income, rack up offshore, but as important, avoiding a plan that permits stripping from higher tax jurisdictions into tax havens. Because as long as we are the master of a tax system that permits that, you're going to see more audits, more changes in laws, and more difficulty around the world. And I don't see in the tax debate much acknowledgement of the fact that a stable international tax system is perhaps as important, or at least an important factor, along with things like rates, et cetera. The only other points I think I would make for general audience, and I think President Obama's min tax, you could argue with the rate, you could argue with the mechanics, but what it did was it took a lot of juice out of running income from high tax jurisdictions into tax havens, because the income would be taxed at a minimum rate. And that also protects developing countries. So I'm curious about whether that kind of approach would be looked at, and we don't get too focused just on this, quote, territorial, as if it's this great thing, because now U.S. companies can go abroad and continue to pay very low tax rates. I think that game is coming rapidly to an end. And the only other comment I would make is, I think one of the things I've learned in Treasury is you do need people who want to think in this space need to make the numbers add up in a way that reputable economists, whether they're at JCT or Treasury, agree work for the fiscal needs of the United States now and into the mid and long term. And so ideas that may sound good but aren't scored to get us the revenue we need are really, I don't think, really advancing the debate. And then the last point I'd make is you do see this kind of segmenting often in the business community where all of a sudden the tech guys want a patent box, an innovation box, and you've just made tax reform harder because you've pitted the brick and mortar companies against the tech companies, and we're never really going to sort out of that mess. The things, without having people come together, the things I think both parties have agreed on is lowering the rates and broadening the base, but boy, that's proven really difficult to get to.
And I would also say that it's not necessarily easy to have the business community all to be in the same place. I mean, certainly with the rate, there are various companies that really care about the rate.
Right.
There are other companies that very much care about going to a participation system.
Right.
There are various companies that are very interested in the patent box.
Right.
So, I think it is optimistic to think that the business community will be all aligned in this very, very difficult issue. But having a stable international tax system is obviously something that's extremely, extremely important, because right now we have an extremely unstable tax system. Just one last thing, you mentioned about having the min tax. I'm a little bit curious about the min tax, so just a follow-up question. Is the concern there with having a min tax is shifting out of the United States, or is there some other principle about shifting among foreign countries that's part of the philosophy behind a min tax?
So the first, it's actually both. I mean, the first element is, there's definitely a perception in the United States government that with cost sharing and the like, the rate differential became such an attractive nuisance for companies to say, well, let's do everything we can to get this IP outside the United States at a bargain price. And now we can secondarily strip from the higher tax into our cost sharing arrangement, and that has created a lot of these international problems, but also adds to the pull, outside the U.S. jurisdiction. I'll add one point, which the Apple case brings home, which is that because the U.S. cost share rules permit not a lot of activity in your cost share participant, and because of check the box, many of these entities that are out there being subject to audits and investigations are entities that don't really have a lot of activity in them, and the rest of the world looks at that and says, how could that be? And therefore, instead of that just being U.S. deferred income, we'll grab it and tax it in our jurisdiction. And that problem is going to go on as long as we have this deferred income offshore.
In the last couple of minutes that we have, the recent events, obviously the finalization of the Section 385 regulations, and just a couple of observations. The general rules, the general structure is similar to documentation rules, also some per se recharacterization rules. But some very important changes were made. For example, the bifurcation rule of -1 was removed, and now it only applies to U.S. issuers. There's now a cash pooling exception, and now that it only applies to domestic issuers, in essence, there's a foreign-to-foreign exception. Can you make any general observations? Because what's interesting about it is that the focus, the scope of the proposed regulations was much broader. Even the preamble was much broader than the final regulations. The proposed regulations obviously was very interested in stripping, a U.S. subsidiary stripping out to a foreign company, so the inbound situation. But also the proposed regulations seem to be concerned about inbound transactions as well. That is to say, where you have a situation where you have a foreign subsidiary bringing cash back into the United States, the repatriation issue. The final regulations seem to be focusing more on the stripping side of this, and by limiting it to U.S. issuers, not focusing on the repatriation side. Can you make any general observations about the process by which
Yes. So first
you
of all,
made the decisions how to scope the final regulation?
Yeah. So first of all, I do want to say I'm extremely proud of the work we did at Treasury and with working with IRS. I mean, the APA is supposed to be all about putting out proposed regs, taking comment, meeting with stakeholders, listening in good faith, and trying to adjust, in the right way. So we did that, and we're very proud of that. Look, this isn't really that hard to understand. If you look at the tool of 385, it's a tool that you might say says this should apply for all debt equity issues for all U.S. federal income tax purposes. And that was very much the flavor of the proposed regs, which then would have swept up things like repatriations where you're using a debt or something to do it. As you moved along in the process and as we listened, you then could ask yourself another good legal question, which is, well, do we really have to take that principle to the nth degree in situations where the effect on the fisc isn't that great? And then if you answer that question, well, no, we don't have to, you can say, well, regulatory entities like banks that, can't really do the stripping because they're overseeing the foreign issue. You can almost kind of parse through all our exceptions and view it in that light. And that's really, I think, kind of in a very, very broad way, the logic that led us to where we got.
Yeah, what's interesting about it is, just focusing on the two aspects of it, it'll largely affect companies, foreign companies with investments in the United States, subsidiaries in the United States. But more broadly, I would just say the documentation requirements, yes, are only going to apply to U.S. issuers, but of course the focus, documentation generally is a best practice with respect to intercompany debt. I mean, as we've advised clients, look, just because these specific rules may not apply to you, the common law is still going to apply.
Right.
Have you done the documentation to prove that you have debt rather than equity? In the regulations, there are various reserve sections, for example, with respect to foreign issuers, with respect to bifurcation of debt into part debt, part stock. Any comments with respect to the reserve section, what's contemplated with respect to the reserve sections at this time?
I think as a practicality, given the time and the administration, that will be stuff that the future administration will be able to look at, work on, pick up. And to some degree, you want them to have that freedom when you're, towards the end of an administration.
So what you're anticipating at this point is not moving on to other projects.
Yes.
For the remainder of the time.
Yes.
There's still a lot to be done. Well, I think we are about out of time.
Great.
It is time for the cocktail hour.
Great.
So I will.
Thank you.
This is a good place to break. So we'll start right here. Thank you very much, everybody.
Thank you. Thank you very much, Bob. Thanks, Eric.